Hello everyone. Welcome to our monthly session on GST and technology. For a change, today's session is not carrying any technology aspects. It's been our endeavor that all finance professionals to get updated on all aspects of GST and technology. We've been doing this session since the inception of GST, and there has been consistently a response from the participants that they are getting good knowledge, and that gives us an encouragement to do the sessions. Today, 53rd Council meeting minutes related discussion we are having. There are two parts to it. We have around 16 circulars issued 3 days back. We would be covering those circulars. And there are many parts of the 53rd Council meeting where the notifications are awaited. Some of them would also be coming by way of amendment to the Act, which would be coming very soon. So we will also have a session on the Act when the amendment to the budget happens in mid-July. Friends, the 53rd Council meeting, it's kind of happened after an year. So whatever the issues the Council has noted, because 17, 18, 18, 19, the time limits were over, 19, 20, all like the orders were getting processed. There are a lot of replies issued by various professionals across India. Many matters went to first appeal, most of them got disposed, pending, awaiting for the tribunal to be formed. So the council is also now aware about the kind of the questions that have been raised by the departmental officers, the judicial positions which has been taken by the tax position taken by the SSEs, and to avoid certain disputes, to avoid certain tax clarification positions, to avoid the future litigations, this council has taken a lot of decisions. Those who are in GST practice, it is mandatory for you to attend at least 2-3 sessions of 53rd Council meeting updates. Today, as I said, we have divided into two parts where the clarifications which happened in the council has come by way of circulars, and something which is yet to come will be in the second part. With me, my colleague Ashika, who will be walking us through the various parts of the section. I know it's a 3 hours we are going to discuss. Be patient, look at various things. I would suggest take pen and paper, notebook, make notes. We will try taking through the various provisions slowly and very in detail. Feel free to ask your questions wherever you have in between, and you can interrupt us. Right. With this note, I welcome Ashika, and Ashika, over to you. You can present the session.
I hope screen is visible.
Yeah.
So, as Sir said, today we will be discussing about the various recommendations which has been made by GST Council. Plus, pursuant to that recommendation, the clarification which has been issued. So, as sir, we are dividing into two parts. First, we will be discussing what for which, based on recommendation, already clarification has been issued. And the another part we will be covering, which is yet to be clarified or yet to be implemented. So, starting from the point of which clarification has been issued. So as Sir said, 16 circular they have issued. This time in 53rd GST Council, all the decision, clarification which has been issued, they are all issued more or less to and the litigation, to reduce the litigation which was happened in 1718, 1819, 1920. Basically, to cover the situation where taxpayer were facing difficulty, even where the tax officers were having different point of view with regard to their taxability and interpretations. On that basis, 53rd GST Council has made various recommendations, and all the recommendation which has been made is a welcome one. Now, when we will discuss one by one, we will understand what are the clarification made and what is recommendation yet to come, and how it is a beneficial for both, even for taxpayer and tax official, because it will help to reduce all the pending, to decide the pending cases, plus which is going to come in future. So clarification part, we will be going in this fashion. First, we will be discussing about the monetary limits for filing appeal. Thereafter, we will be talking about taxability, valuation, place of supply, time of supply, ITC, relation to related party transaction, and special procedure for manufacturing. I have not gone circular by circular. I have gone by topic wise to have more clarity and to understand how that clarification should be read and how it will be beneficial for us. So first part, starting with monetary limit for appeal. Now, when I am talking about the monetary limit for filing appeal, first thing, this circular has been issued from the point of department appeal. As you are well aware, whenever an order has been passed, option is given to both. Even the department can also go for appeal, and I can also go for appeal. SSE can also go for appeal. It depends upon what's the order is passed. If order is passed against the appellant, against the SSE, then obviously SSE will be going for appeal. And where the order has been passed in favor, option has been given to department to go for appeal. But that appeal he can do only and only when it has been asked by the higher officers. So if you will note, section 108 of GST Act provide a power to do the review of the order pass. From there, the department get the power to file an appeal before the order pass. So wherever the commissioner feels that the order which has been passed is prejudicial, or it is ultra vires to the act, or it has been passed erroneous of the provision of the law, in those circumstances, commissioner has the power to direct the jurisdictional officer or the officer passing the order to file an appeal against that order. So as the power has been given for department to file an appeal, they have come up with this monetary limit in order to cut the cost of the department. So they don't want for each and every issue, wherever favorable order is passed, department immediately should not go for appeal. So for this purpose, they have come up with monetary limit. It may be noted, it is for monetary limit, not issue-wise they have defined. So what monetary limit they have given in order for department to go for appeal is, if you are going before tribunal, you make sure that demand should be around 20 lakhs. It should be above 20 lakhs. If it is High Court, it should be above 1 crore. And if it is Supreme Court, it should be above 2 crore. If demands involve of such amount, then only department can go for appeal. Another important thing which comes in the mind that, okay, some limit has been given, but how that limit should be calculated. So they have also given the basis for calculating that limit, that if there is a case where there is tax, interest, penalty, all are there. Normally, as we are standing in 24-25, most of us has received some or the other notices. Either we have received ASMT 10 or we have received demand notice under section 73 or 74. So you will notice whenever an officer pass a notice, they write you are liable to pay tax of rupees this along with interest thereon and penalty either under section 73 or 74 as the case may be. So where all the three elements are there or where tax is disputed, then over there, this 20 lakh limit is to be taken from the base of tax. So if suppose, for example, I am liable to pay a tax of rupees 1 lakh, on which interest comes, suppose 80,000, and on which penalty of rupees 20K has been imposed. So 1 lakh is tax, interest is 80K, penalty is 20K. Under such circumstances, only tax need to be checked. Now over here, my tax quantum is less than 20. So department will not go for an appeal if it is appeal to be filed before tribunal. This limit operate when the appellate tribunal comes into picture. Prior to that, means one more appellate authority is there, that is a joint commissioner appeals. So for filing an appeal before joint commissioner appeal, there is no limit. If your turnover, if this limit is below that also, officer can go and file an appeal before it. However, there may be a situation where there is no dispute about the tax. Disputes relates to only interest, penalty or late fee. So where it is relate separately only for interest, only for penalty or only for late fee, then it will be applicable according to that only. So when it is coming with tax, then tax need to be checked. When it is separately, then separately it's to be checked. But where in the notice, all three components are coming apart from tax, interest, penalty, and late fee, then they are saying you have to consider aggregate of it. So if tax is there, then on tax. If tax is not there, whatever interest, penalty, late fee, whatever may be imposed or whatever has been alleged, you are liable to pay. Total of that you need to take in order to identify whether department can go for appeal or not. This is a very welcome provision. Why? Because it will help you to avoid dispute of small quantum and it saves cost to the government. Another important thing is there may be a cases sometime officer pass for 2 or 3 show cause notice to gather a composite order, because it may be a case it might involve similar issue. So being a similar issue, they might pass composite order. Now, as we are passing composite order, which may be of 3 year or 4 year together, individual notice wise, you may be falling below this limit. Individual notice wise, you may be falling under the limit. But when all the notice, when total order is taken, your limit may be exceeding this limit. So they have clarified that under such circumstances, where there is a composite order, then I will not go by individual notice. Individual notice may be below limit, but if it's compositely, it is exceeding this limit, then power has been given to department to go for appeal. Now, as we should not get excited that, okay, we went for a show cause notice, our reply has been got, they accepted it, they passed the order, jurisdictional officer passed the order in our favor. As I discussed, under section 108, power has been given to review the order. So if our order quantum is below that limit, then it's obviously that officer will not go for appeal, and thereby you will have some kind of what we say, we can get a break from litigation. That issue will be end. But there are cases, even though limit may be below, but if order is passed involving which result into any ultra violation of the either act, rules or notification or circular, so it need to be checked on what basis order has been passed. If order has been passed basing deciding anything to be ultra virus or it is of interpretational issue, then this monetary limit will not apply. So it will all depend upon case to case. We can't take it one straight jacket benefit that as it is below 20, no appeal can be filed. It's need to be decided on case to case. What's the issue involved? On what basis order has been passed? Is order has been passed on any interpretation of the matter or ultra virus of the provision, or which the department feel it is an adverse comment which can result into a problem for industry wise issue, or there may be a other issue which may arise, which board may think under the circumstance, even if it is below monetary limit, department has been given power that they can go for appeal. See, when department doesn't go for appeal, it doesn't mean that he has accepted what you are saying. So when an order has been passed, which is saying that what the SSC is saying is correct, and therefore I am dropping the demand. As the demand in that order is below 20 lakh, department may not go for appeal due to this circular, because not because of the fact that what the order has been passed is correct, but due to this monetary limit. So it should not be assumed that department has accepted the fact that what you are doing is correct, or this item you are not liable to pay tax, or this ITC is you are eligible to claim. This you should not construe it first. Plus, if in one case, in one party, department has not gone for appeal, or even where they have gone for appeal and due to this monetary limit, it has been withdrawn, another SSC can't take help of it and say that, okay, in this case, you have accepted it. Therefore, in other cases also, you have to accept it. In that way, it will not work. Therefore, the officer has been advised to write in their file why they are not going for appeal. If they are not going for monetary limit, they have to specify that they are not going due to this monetary limit, thereby preventing other SSC to take the help of this case and to say that this is a decided case. Even there can be a situation in 1 year, suppose 17-18, they didn't go for appeal because it is below 20. But after 18-19, it is crossing above 20 limit. They can go for appeal. Like it is a recurring nature, and next year is increased 20 lakh. You can't assume that 17-18 department has accepted. So the reason to be recorded why they didn't go for appeal, if it is not on merit just due to monetary limit, it is open for them to go for it. Now, second clarification which they have issued is about the taxability. In taxability part, we will be discussing about the two issues. One, where there is a issuance of ESOP, where the companies give shares to their employee. And another, we will be discussing about what would happen in case of insured vehicle, where the insured vehicles are being sold out or sale as a salvage or scrapped, how the same should be dealt with. Now, starting with the fact where the companies are giving to their employee shares. Now, what is happening and what is clarification has been issued. Now,
Ashika, let me explain this portion which is on the ESOP, because this is little important. There are situations where the department has taken a view on taxability of incomes which are construed notionally, especially the capital receipt, mainly with respect to share premium that has been received. Now, that went into a lot of debate because of there being an entry in the HSN, which is Service Accounting Code, on holding services to a subsidiary on securities. While after a lot of debate, once this issue was put to the rest, now by then the officers started looking into the various transactions happening between the holding and the subsidiary company. And one of the transactions which they have noticed is the subsidiary company making some payment to the foreign company. The subsidiary company is making some payment to the foreign company. And why are they making the payment? Because the ESOPs have been issued. So there is some monetary element that is involved. And like there could be different terminologies. It is either ESOP, ESPP, RSU, restricted stock units. There are different terminologies that have been used by the companies. Now, why do they do it? Because this is a tool to incentivize the employees by offering the securities as a part of their compensation. So the employees kind of become part of the shareholder of the company, they own the company, they bring the loyalty. These subsidiaries are 100% held, the shares are held by the foreign company. When the ESOPs are issued, the shares of the foreign company is issued. Please note, the shares of the foreign company is issued. So today, the discussion that we are talking is the foreign company shares issued to employees of Indian subsidiaries. How does it happen? The domestic subsidiary in India, it would offer ESOP RSU to its employees. Employees will exercise their options and receive the shares directly from the foreign company. And there would be a time limit, vesting period, or exercise, all those things. And the foreign holding company transfers the shares directly to the employees and do not collect any money from the employee. However, it doesn't mean that it is a cost to the foreign company, it is a cost to the domestic company. The domestic subsidiary company will reimburse the foreign holding company on a cost to cost basis. The cost method is computed. It is said that these are the market value of the shares which are at the time in which it has been issued. And sometimes if it has been issued for a discount, that has been recorded as a cost. There's an accounting process to it. Now, so upon the exercise of the shares, the transfer from the US based parent company to the Indian company, Indian employees, the Indian subsidiary will reimburse to the parent company exact cost of the shares. The cost which is otherwise written off in the books of the foreign company is reimbursed by the Indian parent company. It is again becoming a cost to the Indian parent company. Now, this is actually a security transactions which is outside the purview of the GST. Let's take an example. If the foreign holding company, if the foreign company is issuing a stock to the Indian company at, let's say, at $50 per share, they are issuing $50 per share to Indian employees, and let us say 100 shares have been issued. So which is 500 shares of $50 each, which is $5,000. Now, the US parent company generally collects $5,000, but there are also the companies, the US parent company, along with this $5,000, because it is doing all the paperwork, it is doing a facilitation activity to one of its subsidiary. So it is a common practice. The foreign subsidiary companies would also charge a facilitation fees. Let's say in the current example, $5 per share they are charging facilitation dollar fees. Now, for 100, it is $500. The US parent company will be charging the Indian company $55 per share. $50, which is the cost of the share, $5 is the facilitation fees. The council, after the 53rd council meeting, discussed in length, and in circular 213, they have clarified this $5 fees is subject to GST in India, and the $50, it is purchase of shares. It has got nothing to do with the GST, and there wouldn't be any GST. The $5 fees would be paid on a reverse charge basis by the domestic company. So this is one clarification which is issued with regards to the ESOPs. Yes, Ashika.
Moving into next part is insured vehicle. Now, in case of insured vehicle, where the vehicle has been seriously damaged, then it can be a case where the owner sell that insured vehicle. Now, while selling that insured vehicle, it may be a case they might get some amount, some salvage value or wreck values, like sale as scrapped. Now, the question which arises and for which clarification has been given is how whether insurance company is liable to pay any tax on that salvage or scrap value that has been realized on sale of that insured vehicle. Now, when a person got an insurance of a vehicle, insurance company is definitely going to insure the vehicle to the extent it is covered in insurance policy. Now, if a person realize some salvage value, then insurance company generally give insurance by deducting this salvage value. So what they do, if your insurance claim is of, suppose, where you have claim of 10 lakh, and out of which 8 lakh, 10 lakh is the car value, out of which you realized only 50K as a salvage value, and around 8 lakh it is covered in insurance coverage. So insurance company will be giving you 8 minus 50, 7.5 lakh. They will be giving it to you as an insurance claim. Now, when they are giving after deducting salvage value, then on such case, insurance company is not liable to pay tax on it. However, when they are reimbursing you 8 lakh rupees total without deducting any salvage value, on such circumstance, insurance company is liable to pay on that 50K. Reason being that insured vehicle become the property of the insurance company, and insurance company is selling that as a scrap. So what they have realized that 50K, on that insurance company is liable to pay tax. But where that realization is made by the insurer, under such circumstance, he got 50K. So on that situation, insurance company is not liable to pay the tax on the same. This is what the clarification has been issued with respect to salvage value of insured vehicle.
I just want to add a point here. See, go by the principles of Section 7. Suffer anything to tax, the taxable event levy, there should be a supply. What is the insurance company's role? Insurance companies provide the service of insuring the vehicle against the damage. They charge premium for this service and they also pay GST, right? Now, when is this deductible salvage that happens? So generally, most of the time, when there is a total damage of that happens, you take the vehicle, or there is a minor damage that happens, and you as a vehicle owner, you will go to the showroom, get your vehicle repaired. The salvage of it, insurance company do not take it. The salvage of it, insurance company do not take it. However, the claim that happens, the claim that happens from the showroom or from the person, there is a deduction that is made. So we can now look at two scenarios. Scenario one, there is a deduction of the salvage value. That means insurance company is settling the claim by deducting the salvage value. So they assume some value, there would be salvage will be there. They will reduce because the salvage wreckage is with the insurer, the person who has insured. The ownership of the salvage is remaining with the person who has insured. Let's say glass is broken. What would the insurance company do with the glass, or the person who has insured do with the glass? It is, of course, glass you cannot sell as scrap, but let's say one plastic item, one rubber item, one metal item, whatever. The salvage is left with the person who has insured. The insurance company would be making the payment. Let's say they have to make the payment of 100 rupees and they will deduct 5 rupees as a salvage and they will pay 95 rupees. Now, in that case, there is no GST liability in the hands of the insurance company because there is no supply of salvage by the insurance company. It cannot be said as 100 rupees is the expenditure of the insurance company, 5 rupees is the salvage money which they have to otherwise recognize, net 95 as a cost to the insurance company. The answer is no. Insurance company has made the estimate and is giving them 95 rupees, right? Hence, this kind of a bifurcated accounting treatment is not possible. There cannot be levy of GST where the insurance company is paying to the insurer the amount net of the salvage. What was the situation two? The full the IDV value, the insurance, the declared value after adjusting the salvage. No, it is computed. What does the insurance company do? They will not do any deduction of the salvage and they pay full value. When a full value is paid, who is the owner of the salvage? The owner of the salvage will be the insurance company. Because the insurance company is becoming the owner of the salvage, the sale value of the salvage will be liability of the insurance company. So this is two scenarios has come. Generally, when there is a total loss happens, most of the times the insurance company takes over the salvage because they will not know what item will be valuing what, and they will pay the declared value of the insurance. They will pay full IDV to the party. In those scenarios, the GST liability for the insurance company would be on the disposal of the salvage. That would be the liability. So that is the clarification that has been given. Yes, Ashika.
Now, this clarification relates to valuation. Now, we all know about the discounts, like where there are target discount can be or purchase discount. So in case wherever a person is giving a discount, so when it is at the time of supply, obviously while raising the tax invoice, discount is given on that tax invoice and GST is paid on the net tax liability. But there are also a situation where it's also involved post-supply discount. So over here, there is an agreement, and based on the agreement, it is decided when the discount will be given. Terms and condition of the discount is decided and based on which discount is given. Now, when the person is giving discount and as it is recognized in the valuation rule that that type of discount you can reduce from your value and you will be liable to pay tax on net value which has been realized or which has been actually billed to the supplier. Now the question which arises is over here, the post-supply discount comes with the three conditions. First, it should be agreed at the time of entering or providing the supply. Second, it should be linked to the invoice for which this discount has been given. Third, ITC relating to that discount has been reversed by the recipient of the supply. So when a person gives a tax invoice, he will be raising for 100 rupees because at that time they won't be knowing, because discount terms and condition can be decided on the way that it will be given only when such achievement is made or such target has been received. So invoice is raised based on the value of the goods. Afterward, yearly, quarterly, whatever may be the terms of the agreement has been provided. Based on this, discount will be given for which separate credit note is being raised. While raising credit note, obviously we will be writing for which to which period and it's related to which invoice you are providing this discount. Now, as you are raising credit note, now those credit note while you are raising, you will obviously mention about, suppose 20 rupees is the credit note, on that GST impact also you will be giving. Thereby you will be liable on the net taxable value of 80 rupees. Now, when you have reported tax invoice of 100 rupees, your recipient might have taken on 100 rupees credit. After 3 months, quarterly, half yearly or yearly, whatever way your manner of deciding the discount, when you raise the credit note of 20 rupees, your recipient is liable to reverse the credit to the extent of that 20 rupees. So over here, the problem which was arising is how we can confirm that recipient has actually reversed the credit. As a supplier, I am reporting correctly in my GSTR1. Everything is representing, but there is no way where supplier can check whether the recipient has actually reversed the ITC. Due to this, now this clarification has come, which is somehow in line with GSTR 2A versus 3B clarification. Over there also they said about if the invoice is not reflecting in 2A, you can get a undertaking from your supplier certifying that, though even though it is not reflecting due to various reasons, that it has been shown as B2C or it has been reported under other GST, and but supplier has provided, that person has provided service to you or goods to you, they have made payment of tax to the government. By giving that declaration on 2A versus 3B, they are allowing ITC. Similarly, for credit note purpose also, they have said you get an undertaking from your recipient. So get an undertaking from your recipient that they have reversed the input tax credit. Now, similarly, like they have given was 2A versus 3B, if it is below 5 lakh, you can get it from your recipient. If it is above 5 lakh, get it from CA or CMA certificates. Now, over here, if you will see that in order to raise the credit note, you have to keep in mind that first, this conditions has been fulfilled, valuation part. Then with this section 34 also come that there should be a reporting in your GST returns. Means GST 1 also you should report, 3B also report. Plus while raising credit note, you can raise credit note only for a financial year. Means earlier credit note was required to be raised invoice wise. So for one invoice, you can raise one credit note. After that, they amended and said you can raise credit note for consolidated invoices also. Means all 3 months, 2 months invoices, you can all together also can raise the credit note. But that also operate, it should be raised financial year wise. So if for two financial year, you can't raise one credit note. You have to raise per financial year, you can raise multiple credit notes. So year wise credit note to be raised.
Ashika, so I think it is important that we highlight this because credit notes are now going to be a special scrutiny, right? Now, friends, let's look at what is the intention of this point, where the government is saying that the discounts given after the supply, the clarification was necessary because there is no mechanism. Earlier, we had something called matching of credits and matching of liability. There was section 42, 43, where it was intended, of course, some of the sections which took long time to see a light. Now, in a credit note, the supplier is reducing the liability. When the first invoice has been issued, let's take a simple example that I have made a supply of 1 lakh rupees and issued an invoice to you for 18,000 rupees. You have availed input tax credit of 18,000 rupees. Post-sale discount 6 months later, you have fulfilled certain conditions. I am issuing a credit note of 10,000 rupees. What am I doing? I am reducing my liability by 1,800. While you have already taken an input tax credit of 18,000 rupees, I have already paid to the government 18,000 rupees. In your liabilities, you have used that ITC, you have set it off. I have also paid that 18,000. For the government records, it matched. 6 months later, I am reducing my liability. That means the subsequent sales that I am doing and I have a liability to make the payment, I am making the payment lower by 1,800 rupees. Now, the government did not give a mechanism. In fact, one of the conditions, section 15, subsection 3, the condition is the recipient has reversed the ITC attributable to the discount. This is a condition which is there in 15 subsection 3. And as Ashika rightly mentioned, section 34, where the credit notes was issued, earlier there was a requirement that the credit notes were to be issued against each invoice. That was there in GST R1, it was faced many difficulties. So they have delinked in terms of credit note being recorded or linked with the invoice. So especially these pharma companies where the goods were returned, they used to take note of all the goods returning and they used to issue one credit note, right? So it would be difficult for them to trace against each medicine that has come, against which invoice they have raised and they are reversing. So they have done away with that provision. Though they have done away with that provision under section 34, under section 15, the condition is still existing. That means the person who is issuing the credit note, it is mandatory for them that the discount or the credit note has to be linked to specifically a relevant invoice. Now, given that this is the mechanism that has been given in section 15, do we have the mechanism? Currently, there is no functionality which is developed by the GSTN portal to verify the compliance with the condition of ITC reversal by the recipient. So what they have come up with, an interim solution. Now, until such functionality is available, the suppliers are required to procure a certificate from the recipient issued by a chartered accountant certifying the ITC reversal. So the expectation is on the supplier that they avail a certificate from the recipient issued by a chartered accountant. Now, how do you know it is issued by a chartered accountant? You all know that every certificate which is issued by a chartered accountant will have a UDIN. So the UDIN is mandatory. And what does this certificate issued? The CA certificate would include the details such as credit note details, the relevant invoice number, the amount of ITC reversal which is made by the recipient. How did they make? By way of GST or 3B reversals or DRC 03 payment or any other, whatever be the mode, how this ITC reversal has happened has to be taken. Now, do I need to upload this certificate along with filing of GSTR1? The answer is no. The answer is no. These certificates have to be obtained and kept by the supplier. These would become an admissible evidence because section 155 mandates that the person who is taking the input tax credit has to prove that the ITC is eligible to him. In the current case, 155 is not applicable to the supplier, but 15.3 mandates that the other person has availed it on a genuine basis. Now, there is a little catch for the officer. How do I know that that person has established? So, to put the onus back on the supplier, now there is a challenge that comes is like people will ask, how can circular now demand something which is not there in the law? Because likewise, there are many other circulars. Now, this is a procedure nowhere in the Act nor in the rules. Like neither in the Act nor in the rules, this procedure exists. But what now they are saying? This would be an admissible evidence which will be serving for the purpose of 15 subsection 3 clause B subclause 2, right? Wherein the supplier would be producing these documents during the proceedings like section 67 investigation scrutiny, 65 audit, 61 ASMT 10 scrutiny, any of these matters, they would be keeping this as an evidence. Now, they have also given a monetary limit. So they said it's not that we have to get in all the cases. They said we will put a monetary limit. The tax involved in the discount exceeding 5 lakh rupees in a financial year, then the undertaking from the recipient can be used instead of CMA. So up to 5 lakhs, there should be a self-certificate by the recipient. The credit amount is exceeding 5 lakhs, then CA certificate. That means if we take an example, like a post sale in discount of 1 lakh rupees has been given. If it is a 1 lakh rupees, let's say 18,000 rupees of that credit has been availed. Now, since this is an 18,000 rupees, the requirement of CA certificate would not be there. So the self certificate, the supplier will be relying upon a certificate issued by the recipient saying that so they have reversed the input tax credit. Now, every credit note, now it is additional corroborative evidence the supplier has to make. Now, this is becoming this, why I wanted to stop and reiterate this, this is creating two issues. Issue number one is circular is now giving up a new provision of the law, which is nowhere in the act or the rules. So, which is questionable. I'm sure many would take up in the due course. Second, the supplier is now mandated to have this document. Very unfortunate thing is, look at like this, we are on 29th June 2024. Ideally, you would be assuming that the circular will be prospective from this date. I'm talking about section 65 audit for the financial year 23-24 happening after 2 years. In 27-28, some audit is happening. And that time, by then, everyone in their mind then say that this is applicable. It would be again difficult thing go to convince back to the officer saying that this has come only this date. So please reckon from this date. I do not have. The officer will say, no, please go and get a certificate from the recipient. Similar to circular 193 and 193, where the 2A credits were missing. It was expected. Go back to your supplier and say that they have filed on B2C section instead of B2B. So something like that, this has come in. So it is very much important that you are aware of this procedure. So you need to create this SOP while filing your GSTR 9 and 9C. You have to see that, okay, fine, so much I am reporting under credit note section. So table 4 in 4L, 4M, any of those things, upward, downward liability adjustment. You got to see, do I have a sufficient confirmation from the recipient saying that he is reversing the input tax credit. This is more important. So look how you will communicate. This is same like that issue of obtaining C form, where every interstate supply that has been made at a lower rate, obtaining a C form and keeping, else that the lower rate is not applicable. Likewise, now the credit note is there, discount is there, proof that someone has reversed the input tax credit and evidence. So the question that came up during one of the deliberation that we internally were having is like, can there be a consolidated certificate is sufficient, or should it be invoice by invoice? Though the circular did not do a detailed clarification, in my view, for the full year, the recipient can make a consolidated thing. But however, look at the fate of the supplier. How will they track? How will they correlate? Let's say the supplier has 10 invoices wherein they have issued credit notes. Now there are 3 credit notes. Against 2 credit notes, there is 1 invoice. Against another credit note, against 2 credit notes, there is 1 declaration. Against the 3rd credit note, there is another declaration. So this is going to become a kind of compliance burden. I would really say this is a compliance burden. But however, if someone wants to make availment of this facility of reduction in the value of the supply, there is no other alternative. You have to go by this circular, unless otherwise this is made as ultra wires, and the wires itself is challenged in any of the courts, and nothing before lower than the high courts. Yes, sir.
Place of supply. Two clarification has been also issued in relation to place of supply. So let us first cover supply of goods. Now, when there was a supply of goods to an unregistered person, a new provision has been entered in place of supply, where it has been said in 10 CA, 10 subsection 1 clause CA, where they have said that in case of supply of goods to unregistered person, place of supply will be considered based on address which has been provided by unregistered person. That is what the address he has provided and recorded in the invoice. Based on that, place of supply will be determined. However, as we know, due to e-commerce platform, there are cases happening where from one state delivery is being made to another state also. So the question which arises before the government was, as you are saying, what is recorded in the invoice. Now, suppose for example, the person who has given the address is also of Karnataka, using the e-commerce platform of the service provider or supplier, goods, who is also of Karnataka. But good is getting delivered to Kolkata, another state, West Bengal. As movement is happening interstate, but due to this section 10, which specifically says to be an address recorded in invoice. So as per the address record, it is showing to be Karnataka, but delivery state, it is showing to be West Bengal. Even though it being interstate, supply is happening. However, CGST and SGST would have been charged. So they have brought in with this clarification that wherever there is a difference in address, recorded address or the registered address of that recipient and the delivery address, then place of supply based on delivery address would be deemed to be the place of supply. Further, it has also been said that suppliers are required to change the place of supply from the recorded address to delivery address. So they have to raise an invoice specifying place, recorded address, delivery address also, and place of supply will be based on delivery address. Second clarification which they have brought about is foreign portfolio investor. Now the question which was raised is, when bank or financial institution provides service, as per section 13, subsection 8, it is said that it will be a location of service provider. So wherever bank is located, wherever the financial institution is located, that is regarded where place of supply, irrespective of the fact where the recipient is or where the service is provided. Now the question which was raised that this is applicable only when the same is provided to the account holder. So whether the custodial service which is provided to a foreign portfolio investor would also be regarded as a service provided to the account holder or not, or based on location of service provider, place of supply will be determined or not. Accordingly, they have said, what does the account holder services include? Thereby saying that account holder service does not include this custodial service. It is a service other than account holder. Therefore, place of supply, which is applicable in banks and financial institutions, that is location of service provider, will not be applicable. It will fall under default rule, which says the location of the recipient. So accordingly, based on the location of the recipient, place of supply will be determined in case of foreign portfolio investor.
Okay. Let's look at the place of supply provision, because the foreign portfolio is a very few people. Now, the place of supply has been kind of a confusion. This has been kind as a doubt for many from the day GST is being implemented. Okay. I'll start with a simple example. I am here in Bangalore, Karnataka. I have a mobile shop. I am selling mobiles. A customer from Tamil Nadu orders for a mobile phone to be delivered to his house. He has made the payment to me online. So I am here in Karnataka, the customer is there in Tamil Nadu. I have sent after receipt of the money, I have couriered the mobile phone to Tamil Nadu. Pretty simple IGST transaction, everyone understands this, no doubt. Scenario number 2, very important. This person travels down from Tamil Nadu, walks into my showroom. he purchases the mobile phone across the counter. He is buying the mobile phone across the counter. So for every shop, any shop, anyone who walks in across the counter, so this is a counter sale. The sale is happening right across the counter. The question is whether this supply should be regarded as interstate supply or intrastate supply. Quite sometime, even today, there are many people who argue that it is the counter supply, the sale is happening across the counter. It should be an intrastate supply, CGST, SGST should be levied. The answer is no. If the buyer is giving his billing address, the address to be billed as the state of Tamil Nadu, the GST of Tamil Nadu should be charged, which is IGST, place of supply would be Tamil Nadu. Now with the e-commerce, many e-commerce operators coming in, today anyone is sitting anywhere and anyone is ordering any product to be delivered to any location. So now the council has decided that, okay, we need to give clarity to it, and wherever needed, we might need to amend the act. But they have now said that we need to clarify in case of the supplies made to the unregistered person. They have clearly said if the supply is made to the unregistered person, the place of supply will be location as per the address recorded in the invoice. So if that walk-in customer is not giving any address, then we all know if there is no address, then the location of the supplier will be place of supply. That means I am here in Karnataka, so the place of supply will be Karnataka. But if the location recorded in the invoice is of Tamil Nadu, then it would be of Tamil Nadu. Further, they have also clarified the place of goods supplied through e-commerce platform to unregistered person. Please note, I am always highlighting this point as unregistered person, and where the billing address is different from delivery address. For example, the person is, let's say, in the state X. Okay, he is ordering a mobile phone. He is in state X ordering a mobile phone delivery to state Y. So the place of supply will be state Y. So he is here in Karnataka placing an order to Tamil Nadu as a delivery address. Like in the Amazon, I have registered, I have an account in the Amazon. In the Amazon account, when I was residing in Bangalore, I have created an account. I might have migrated to Gurgaon, Delhi, Kolkata, Coimbatore, somewhere I have gone. No one changes those address details. What I am always looking at every time when I am shipping the order, when I'm concluding it, there are a lot of options. Where do you want this material to be delivered? You will create home, like parents' house, this address, that address, permanent. You will create multiple boxes. You will select one box and you say, this is where the material to be shipped. So now on the e-commerce platform, whatever the delivery state is written. So even though while I have created my address as Tamil Nadu, please note we are talking about the e-commerce related. Okay, the place of supply will be Tamil Nadu. This is also another thing that is being considered in the council. So two things: if it is a supply to an unregistered person, the location as per address recorded in the invoice. Then if it is through e-commerce platform, then it is the location where the material is getting delivered. This has been considered. I'm not dwelling deep into the foreign portfolio. It's only applicable to the banks. We will move to the next provision.
Coming to the clarification issue on time of supply. Now, for time of supply, clarification has been issued on 2 points. One is spectrum allocation and another is construction maintenance of roads or highway. So over here, first spectrum allocation. Now telecom operators has been given an option. They can pay a full amount at once, or they can also opt to pay for installment based on the agreement. It is inviting tender. It is mentioned when they have to pay and how when will be the installment payable. In that agreement it is specified. So now the doubt which was raised is whether they are required time of supply will arise when the agreement has been entered and awarded to that telecom operator. On that moment, even though a person has opted for installment and paying in parts, or they can consider on the basis of installment, they can determine their time of supply and pay the tax. Like we notice in construction service. In a construction service, we define the events, and based on that events, we collect money from the buyers. So similarly, it was asked for spectrum allocation and construction maintenance of this. So it has been clarified that now spectrum allocation, one more thing is spectrum allocation service is provided by a government. Service which is provided by the government is covered under reverse charge mechanism. So over here, the person receiving, that is telecom operator, are liable to pay tax. As they opt for the installment or even they opt for the full time, it runs for some years. It's not the case that it is for 1 month or it is for part of it. So therefore, it has been said that it will classify as a continuous supply of service. What has been defined as continuous supply of service is service which is provided more than 3 months. So spectrum allocation plus construction maintenance of roads or highway, they continue to be more than 3 months. So both will be qualified as a continuous supply of service. Under spectrum allocation, telecom operator is liable to pay tax because it's a government service. Now on the time of supply, they have said that based on what the option telecom operator has selected, based on which, if he has opted for full time, full payment at once upfront, at that time only GST became payable. Where they have opted for an installment, based on when installment due will be determined, based on that, a telecom operator has to start GST on the same. Coming to the part of construction and maintenance part, over here we know that it work on a design, build, operate, and transfer model. So over here, a supplier first construct the roads, then he is also responsible for operation and maintenance of that roads or highway which has been constructed. So over here, when they enter into an agreement, they don't receive the money at once. It is received in parts installment based on the event being completed. So accordingly, it has also been said that it is also a continuous supply of service. And over here also, time of supply will be based on the agreement entered, based on which it has been determined when the amount will become due to those supplier. Based on that, GST need to be paid. Further, if any extra payment has been made, interest amount or any other manner, that will also form part of the value and GST will be applicable on the same. So this was in relation to time of supply, which has been issued for these two services.
Yeah, Ashika, so again, telecom spectrum is a few cases, but the hybrid annuity model is something I want everyone to pay attention to. Though the example that has been given, okay, in the circular, it was, by the way, this clarification was sought by Roads, Transport and Highway Ministry, because the various assessing officer were taking the different positions and the taxation was happening. Why was like this is like these contracts, if you see, they runs into crore, like 1 kilometer, they will say 10 crores or whatever be the number. And like as Ashika mentioned, these contracts are dual. One is in terms of laying of the road and also operation and maintenance, let's say over a period of 15 years, 17 years, whatever. In fact, the L1, L2, L3, they also place the way they also do It is not just a monetary period. It's not that someone who quoted 10 crores per kilometer. They would also tender it to someone who quoted 15 crores per kilometer. Because if the 10 crore guy says, see, I will lay the low road and it is 1 year I maintain, after that it is not my responsibility. While the 15 crore guy says, look, I will lay the road for 1 year road and next 10 years it is my responsibility to maintain the road. So they have their methodology to determine the L1, L2. Now, the payments are made installments during the construction period and through deferred annuity spread, okay, over the years they will spread. So there will be an interest component which will be embedded in the HAM contracts. And when we say HAM, we are talking about a hybrid annuity model. So there is an upfront payment for some work and there is a payment for the O&M. So even though there is a construction activity and a maintenance activity, the contract is a hybrid, which will say that, okay, I will compute the construction thing and the maintenance thing. I will spread the payment, merging both, I will spread the payment over the period. That's how it is done. So that is why we call it as hybrid annuity model. So HAM projects, and generally all the national highway projects happen like this. Now, this is firstly continuous supply, like 233, which talks about continuous supply of service. This purely fits into it. Now, section 13, subsection 2 defines the time of supply for services, and which will clearly say that it will be earliest of issuance of invoice, receipt of payment, whichever is earlier. But for continuous supply of service, 31 subsection 5, which talks about issuance of invoice must be on or before the due date of the payment or the completion. So that means there are two things. So if the invoice is issued, which means invoice was supposed to be issued on date X, if the invoice is issued on that date or before the specified date, whenever the invoice is dated, that should be treated as the time of supply. But if the invoice is not being issued as per the date that is there might be some dispute, argument, or I know that if I'm issuing invoice now, 6 months later, I will get the payment. Why do I raise an invoice now and show? Whenever I get the payment, I will raise the invoice. So that being thing, then if the invoice is not issued on time, the time of supply will be date of provision of service, which is deemed to the due date of the payment or receipt of the payment, whichever is earlier. So the interest component, which is embedded in the annuity model, is also be treated to the principal supply, because 15 subsection 2 clause D, in terms of the valuation of the supply, the interest will also be treated as the original supply. Now, why am I talking about interest? Because in a HAM contracts, now not that every entire amount is like the originally developed cost is also not paid in advance. That is also deferred. Now, the moment it is deferred, we know every businessman, they would calculate as it is being deferred, they would also add the interest cost and they will put it. If I have to take a simple example, let's say a road maintenance contract awarded for a period of 15 years, and they will say that 40% I will be paying during the construction, and let's say 10 crores is the project cost. They will say 4 crores I will pay in 1 year for during the construction phase. Balance 6 crores is split over the balance 15 years, based on the construction. So post construction, they will do an annuity payment. So either by month, either by half yearly, by quarterly, they will be agree on whatever is the payment. Generally, biannually is what the annuity that they would be agreeing. So the time of supply would be issuance of invoice for that balance 6 crores divided into 15 years. Like for the sake of ease, if I say balance 10 years, which means 60 lakhs per year, and I'm raising biannually. That means every 6 months I'm raising. So 30 lakhs for every 6 months is the installment which is falling due. So at that instance of the biannually or raising of the invoice, whichever is earlier has to be reckoned as the time of supply. Now, most of you might also understand that isn't it simple, straightforward, but These are the projects which is running into crores. And even if I alter the time of supply by just by 1 year, the interest liability with the department which is going to get is a huge, and the SSs, the taxpayers might not be able to budget that additional liability which is coming into it. So to put rest to these problems, the circular 221 has been issued for clarifying the HAM related projects. Now, why am I stressing upon this? Now, HAM related projects, now you can think of the contracts, forget national highway authorities. You think of any O&M contracts where you are privately entering with your customers in terms of, as Ashika was telling about, to boot, to build, own, operate, and transfer. So you are giving a contract saying them they have to construct, and then they will also have to operate it and do it. So that is something that I want you to look at, that these principles, so you can apply the principles laid down in circular 221 in other contracts. We are not just the National Highway Authority HAM, but other annuity contracts, you will be able to apply these provisions. So this is another important thing that you should make note of it. Yes, Ashi.
Coming to the part of clarification issued with respect to input tax credits. Now, for input tax credit, their clarification has been issued on 4 fronts. Now, if you will notice that there are total 5 circulars has been issued, but however, for the purpose of discussion, I have divided the topic into 4 parts. One is first, time limit to avail ITC in case of tax paid under RCM. About the ITC in relation to insurance company, warranty and extended warranty provided to the manufacturer, and ducts and manholes. So starting with the part of time limit to avail ITC under RCM. Normally under 16.4, we know that there is a time limit to avail is 30th November of the subsequent financial year. When we see section 16.4, it talks about invoice and debit notes. When we come to an RCM part, over here, we have been made to pay tax, where supplier is a different person. We are liable to pay because we are the recipient and they have given a notified goods or service on which as a recipient, I am liable to pay tax. Now, the question over here is, generally, invoice need to be raised by the supplier. Recipient doesn't raise the invoice. But under GST for RCM, they have provided the provision, thereby they said that recipient is liable to pay raise invoice in case where they are paying under RCM. But it to be noted that in all the cases, recipient is not required to raise the invoice. The invoice which is raised is called self-invoice, self-tax invoice. Now, invoice to be raised only when the notified goods or services has been received from unregistered person. Because when we receive from a registered person, as we can see also in our GSTR 2B, that those supplies are duly reflecting in our GSTR 2B. If my supplier is a registered person, he will be filing, that person will be filing their GSTR 1 return, where I have the option, whereas a supplier has the option to select whether tax is payable under RCM. Yes. The moment he select yes, that will be showing in my GSTR 2B as RCM liability. So when a person who is supplying me is a registered person, then for RCM, though I am liable to pay under RCM, but I am not liable to raise the tax invoice. But when a person from whom the notified goods or service has been received is unregistered, under the circumstance, obviously he will not be filing GSTR 1, it will not be auto-populating in GSTR 2B. Under those circumstances, the recipient is liable to raise the self-tax invoice. Plus, with the self-tax invoice, there is one more compliance being a recipient of RCM need to be done is issuance of payment voucher. Payment voucher is to be issued irrespective of the fact whether the supplier registered or unregistered. And secondly, for payment voucher, we can issue consolidated payment voucher. Means all together for a month for one supplier, one payment voucher. But when it comes to self-tax invoice, it to be raised separately. Now, with the understanding of the fact when the self-tax invoice to be raised under RCM, RCM, we have been provided separate time limit also to pay the tax. So if it is a notified goods, then we are liable to pay tax earlier of date of receipt of goods, 31st date from the date of issue of invoice or payment date. If you will notice that there is no invoicing date is mentioned under RCM. If you see the goods or service, under both, invoice date has not been specified as a date of time of supply. Because over as a recipient, we are liable to pay. That will depend in case of goods when the goods is received or after 31st day from the date of issue of invoice if it has been issued. Even though if it is an unregistered person, may not be issue a tax invoice known in the language of GST, but he will be obviously issue you some receipt showing that he has sold that good to you or payment date, whichever is earlier. When it comes to service, it will instead of 31st day, which has been provided for goods, it became 61st day or payment date, whichever is earlier. Because for date of service, date of receipt of service being intangible, there is no surety can be provided that when the service has been received. Therefore, date of receipt of service is not there. But in case of goods, same can be traced, been tangible by way of e-way bill compliances or goods inward notes. It can be seen when the goods has been received. So this is the difference between time of supply for goods and service. Based on this time of supply, as a recipient is liable to pay tax on the same. Further, if we go to condition for input tax credit, one important thing also over there is you need to make the payment to your supplier within 180 days. But when it comes to RCM, this condition is not applicable. ITC eligibility is dependent on the fact whether you have paid the tax or not, irrespective whether you have made the payment to your supplier or not. It is just one point which we want to bring while discussing about the clarification which has been brought. But before going into clarification, first let us understand what's the basic which relate to RCM we need to comply in order to understand the clarification better. Now, as we discussed, that self-tax invoice need to be raised when received from unregistered person. And we understood when we are liable to pay tax. Now, as we have to raise the self-tax invoice, now the question will arise when it to be raised. It will be based on time of supply or is there any other provision? So section 31, 3F specifically deals with self-tax invoice and it specifically provide when it to be issued and it to be issued on the date of receipt of goods or service. Irrespective of when tax to be discharged, you are required to raise the self-tax invoice on the date of receipt of goods or service. Now, the clarification which has been given is under GST as recipient has been asked to raise the invoice. And for time of supply under 64, invoice date or debit note date is relevant. But ITC is eligible in case of RCM only not on the base of invoice, but subject to payment of tax. So in order to claim RCM, two compliances are important. First, there should be an invoice, self-tax invoice. Second, there should be a payment of tax by the recipient. When both are compliant, then only you can claim the ITC. Now, as lot of audit investigation has happened and people have come to know about the facts that this were liable to under RCM and they have not paid the taxes or they have discharged when the same has been pointed out by the audit officer, investigation or jurisdictional officer. They are coming to know and they are discharging now. Now the question which arises is as they are discharging now, it means they would be raising the self-tax invoice now only. So let us take the example. 2019-20, as legal service was there, which was missed out to pay. And while in 25 or 25, you came to know about that liability. So as you have come to know about that liability, you will be paying tax on the same, and you will be raising sales tax invoice also. Now the invoice which you will be raising will be dated of 24. Like we are standing in the month of June. So let's say 30th June 2024, you are raising a sales tax invoice saying about the liability to be discharged for 2019-20 legal service. Now, as you are raising sales tax invoice now, this clarification says that time limit of 16(4) for RCM will operate based on date of invoice in which financial year it has been done. So as we are raising in 24-25, so my last time limit to avail this ITC will be 30th November 25, even though liability belongs to 1920. So not based on liability when it has accrued, when you have become payable, but based on when you have raised a self-tax invoice against that liability will determine your ITC eligibility and time limit for this. As we are doing delay, as 1920 has been discharged in 24-25, therefore you will be liable to pay interest, plus there can be a penalty also due to delay raising. That also has been provided under the circular. Penalty is still, in my opinion, it will be covered under 122(3)(e), which discuss about the failure to issue the invoices in accordance with law, which prescribed a fee of 25K under CNS separately. So in my opinion, it will be covered, even if it is covered under penalty for delay filing, it will be covered under that subsection. So this is all for time of supply for ITC, RCM.
Yeah, so before we move to insurance company, Ashika, 16(4) is much talked upon the subject, and the especially the RCM on the self-tax invoice. In fact, I still remember in some of the sessions, I myself have told that the department is not going to argue this point that the self-tax invoice has been issued today and the credit would be available today, because Section 31 clearly tells that the self-tax invoice has to be issued. Now, if you are not issuing an invoice within the specified time, then it is not going to be a document, right? This matter has gone into appeal in most of the cases, and I would say 99% of the cases, the first appeal, the commissioner appeal, has rejected this view, and all these cases are sitting in front of the tribunal to come up, and now everyone will be doing it, right? The council thought, I think, to reduce kind of some of the notifications are to reduce litigations. Having said that, I wouldn't be surprised that they may bring an amendment in the act to put rest to this problem. We will have to again wait the act coming up, that for the specifically provision coming up for the self-tax invoice, the time limit to take the credit. Now, having understood the clarification and the position of the law, the wordings which is there as on today, the wordings which are there as on today, like Ashika has taken one example, and it's very important that we understand this 16(4) only RCM. By the way, please note this is only RCM case. So she has taken the example of that legal consultancy services. So received from a lawyer who is registered, he would anyhow issue an invoice saying that the recipient has to pay. Those cases are not addressed by the circular. This circular is addressing the legal consultancy services received from an unregistered lawyer. Now, let's take the consultancy service is received in Jan 23. Financial year 22-23, January 23, I have received this service. My liability to pay tax is in the month of February. My entitlement to a credit is also in the month of February. Now, I didn't do it. I realized this only when the team is doing the statutory audit in September 23, this was realized. they have raised the self-tax invoice saying that so much liability has to be paid, 18% on the so-and-so legal fees. When was this raised? It was raised in September 23. A liability pertaining to Jan 23, credit was supposed to be taken in February 23, tax liability was to be paid in February 23, but discovered in September 23. After having discovered in September 23, I was waiting for the GSTR 9 and 9C. In December 23, I have made the payment. Now, question that comes up is with the amended act, the due date to avail the credit is 30th November. Now, in the question, the current question is whether it is 30th November 23 because it's pertaining to financial year 22-23 or self-taxes invoice is raised in 23-24. So will it be 30th November of 24 because I paid it in December. So the circular said that the time limit, the recipient can claim the ITC on this self-tax invoice up to 30th day of November 24. So now the issues that will be, which everyone have to look at it is to avoid litigation or liability to reported in the notes or to put rest to the problems. Many of us by way of ADT 02 observations in the DRC 01 observations or DRC 07 liabilities before the order, after the order, we have paid the RCM liability by way of DRC 03. The question that would come up is, can I now ask for a refund of it? I doubt. Can I ask for rectification of this order under section 161 considering the circular which is there now? I doubt whether the department would do any rectification of the orders. So Ashika, I would like to hear your views on the taxes that were paid using DRC 03. Credits were not taken. Refund can we claim on the DRC 03? Or can we ask for a rectification of the order that has been passed? So alternatively, can I take a credit under 3B now? And I fear none of these options available, but like the options which I'm saying is, can I take a refund of DRC 03? Can I go for rectification of order under 161, asking the DRC 07 to be issue one more DRC 08 with a revised lower value, and this is no longer payable, or take the credit of the tax now? Is any of those options, would that be possible? What do you feel, Ashika?
So the way the clarification has been given, we can take advantage of it, but obviously time will define, because as 1313F is specifically that you were required to issue on the date of receipt of goods or service. Accordingly, time of supply is also there. Now the circular is crossing those provisions. Though it is in favor of the SSC, but I never feel what has been paid will ever get from government. But we can try one appeal and see how it can work out.
Yeah. So by the way, Ashika represents the litigation matters, and most of the time she is with the department handling some of the other case with the commissioners and the higher authorities. She is of a strong opinion that we can fight, we will fight, and she is not giving an assurance saying that ki ek bar paisa de diya wapas aayega. So I'm of the same view that very unlikely that you can claim a refund of the taxes that you have paid. Now, one lesson, whether right, wrong, whatever, I am of the view that if you think there is an iota of doubt, that which is right, or there are two alternative views and opinions are available in the market. I don't know which is right. The courts have not settled it yet. Whenever thinks of that, I would always say that you should contest. Now you may say, sir, if I contest, right? If I contest, I am paying penalty and interest. Now, penalty is something which we cannot avoid, right? So if you agree and want to settle it, that's a different thing. But you want to take a risk, you want to contest, then whatever the penalty that you pay you will also get a refund of it. Okay. For filing appeal, the 10% is computed only on tax. So the penalty comes only when you lose. So you can take the next chance saying that I will pay 100% of the tax. By the way, whenever you are disputing something, not necessary that you only pay 10% of the tax and go for appeal. You can pay 100% of the tax. Now, what will that give you a remedy? You can seek for an interest relief in your prayer. Because now, why am I saying that seek for interest relief? Because the amount that is paid as a pre-deposit is an amount paid and it is not a tax. There is another interpretation that is coming saying that the tax is still due. So you can say, see, I am paying 100% of the tax. In case if the appeal is not in my favor, you appropriate the tax, the amount that has been paid, give me relief for interest. Penalty, of course, you will have to pay. But on the contrary, now with the circular in the hand, you can always go back to the officer and say, look, that my view has been upheld. So that means this credit I am eligible. Here, what is that you will contest for? You cannot contest saying that the liability of 23-24 is being demanded now, which is not right. No, you should contest for make the payment of taxes, take the credit. So the ideal procedure should have been take the credit, which means in your GST or 3B you are taking a credit which is otherwise not there. Now this credit you have received a notice. Against that notice you have citing this is the thing and you have filed an appeal. And now you can say that this credit is eligible. Now, having said that, if some of the cases which have not been contested and it is open, you want to take a position, the answer could be yes. But I still have to look at case to case and give an answer. But I want you to think this and keep it open for the saving some cost. Yeah. Any other point you think, Ashika, on the 16.4 RCM?
No, sir.
All right, let's move to the insurance claims.
This clarification has been brought in for insurance company. First is for life insurance service. Now, under the valuation, they have prescribed a special mechanism for them where they can pay, they are required to pay on the based of premium charge. As you can see, it has been said where it is in relation to investment or saving, then that should be reduced from premium charge. And based on that, first year it will be 25% and next year it will be 12.5% will be considered as value. Over here, 25, 12.5, we are talking about the valuation part. Means what should be considered as a value on which GST rate will be applied. So they have given a special manner of how the value to be calculated in case of life insurance service. Now, as we see this, so we came to know that premium may be charged 10K, but based on this valuation rule, so first 25% first year, like 25% of premium charge. So 2,500 will be the value on which you will be liable to pay GST. Balance 7.5 will not be considered as a part of value and no tax will be paid. Now, the question which arises is, as there has been given a special valuation mechanism to discharge tax and part of the value is becoming where no tax is payable. Due to it becoming no tax payable, that value first what you will call? Will you call it to be exempted value? Will you call it to be a non-taxable value? Or will you call it as a nil rating? Whatever may be the term where no tax has been discharged. As a part of it is there where no tax is discharged, whether I would be eligible for 100% ITC or as per rule 42, 43, I need to do the reversal. Now, clarification has been given that the value on which tax is not levied is due to the valuation mechanism. Due to that, that value on which no tax has been charged does not become exempted value, and therefore Rule 4243 with regard to ITC reversal will not be applicable of it. Now, this has been issued for life insurance service, but there are various other service categories which are also covered, like air tickets. So it's mean in though these are all clarification, whatever we have discussed from the starting of the session till now, all has been issued is clarification. Nothing relates to change in the provision of law. They are just clarifying how to be dealt in this situation. But as it has been issued of life insurance service, one of the valuation mechanism, it can also be utilized in other valuation mechanism where based on this type value is determined and tax is paid. So therefore ITC reversal should not be made. Second part is about insured vehicle. Now, as we discuss about the part of total loss and partial loss about the salvage value and wreck value. Another thing is when the insurance is covered, insurance also includes repairs and maintenance of insured vehicle. So when the repairs and maintenance of insured vehicle is happening, that vehicle which is insured, part of it is also reimbursed by the insurance company. Now, the thing which arises, those repair and maintenance expense is actually not incurred by the owner. It is actually been passed on to insurance company due to the policy taken. So as insurance company is bearing this cost, the question which arises on this cost, whether ITC can be taken. Now, insurance vehicle can be there can be a two modes. There may be a cashless or reimbursement. In the sense, sometimes we give the policy and the repairs and maintenance shop directly bill it to the insurance company. Another mechanism is where owner made the payment, and after making the payment, he himself applied for the insurance claim. In both the situation, it has been clarified that the expenses, this expense for which insurance claim is been made, insurance company will be eligible for ITC of it. But the condition is the bills which has been raised by that shops or that repairs and maintenance service provider, it need to be in the name of insurance company in both the cases, cashless also or reimbursement also. And insurance company will be eligible to the extent they made the reimbursement, because they don't make 100% reimbursement. It depends upon the policy. So to the extent they are reimbursing, to that extent, or to the extent they are actually bearing the cost of that repair, to that extent they will be eligible for ITC. So these are two in relation to insurance company.
Yeah, I just want to add this portion, the ITC repairs. Generally, friends, we know that any repairs and maintenance of vehicle, credit is not allowed. Whatever the 17 subsection 5 clause A, the list of vehicles, the input tax credit is not eligible. The repairs and maintenance of those vehicles is also not eligible. However, the proviso entry number 2 gives an exclusion for the supply of general insurance services in respect of such motor vehicles which has been insured. So we also have the insurance is being taken out for the purpose of that. Now, for the insurance company, look at their P&L. The P&L for the insurance company, on the income side, I have insurance premium. On the expenditure side, I have repairs and repairs of the motor vehicle. Now, you can always say that repairs and motor vehicles was blocked. So the next question that comes, okay, this is allowed for insurance company, but did insurance company incurred this repairs and maintenance? The answer is no. Repairs and maintenance was incurred by someone. So someone's expenditure you are recording as a cost in your books. If it is not your expenditure, you are recording cost in your books, how you can claim an ITC of it? This was a issue that has been taken up by some of the field officers, and they found this to be a great revenue leakage and create a demand. And even here, there are two things. There was a cashless mode and the reimbursement mode. In a cashless mode, the insurance company directly makes the payment to garage. In a reimbursement mode, the garage does all the work. Garage collects the money from the insurer, the person who is insured. This person will make a claim basis the approval. The insurance company process it. In both the situations, please note, in both the situations, the repairs and reimbursement bill has to be in the name of the insurance company. The expenditure bill has to be in the name of the insurance company. All right. Now, so a question comes up, can section 16 be applied? The answer is yes, 16 test will also pass. These are the expenditure the insurance company is incurring in the course of furtherance of the business. Their business itself is the reimbursement, so there cannot be denied that these expenditures are not for insurance company, these expenditures of some third party, hence it is section 16 violation. The answer is no. The only thing that one has to look at is the invoice issued should be in the name of insurance company for the approved repair cost. If the invoice is not in the insurance company name, the ITC is not available because the conditions of section 16 subsection 2 is not met. Which condition of section 16 subsection 2 are we talking? We know 2AA has come. So now rule 36 has, the 36.4 has come. So the newly introduced AABA, wherein the credit to avail has to be reported visible in 2B. The circular 183, 193 has sunset clause. So they are only for prior to 1st January 22. So they have been given. Now, where can I apply this? How can I use this circular in my day-to-day affairs? If you look at, of course, that is what actually in the same line, the warranty and other things are being covered. So anything that you are incurring as a contractual for someone will also be in the nature of the business. That is what you have to take. Yeah, actually, but let's look at the warranty. You will get an idea. Ashika, let's continue with the next part of it.
So after insurance, let us look into warranty replacement and extended warranty. Now for this, they have already earlier issued a clarification and they have explained how the taxability and ITC will work. This is further clarification to that clarification. Now earlier they have clarified that any replacement which is done under warranty period, there was no requirement for reversal of ITC. Reason being, when you have provided the warranty, you have covered the cost of the goods or part thereof which you are going to replace under warranty. So accordingly, as it was provided in earlier circular about the parts, over here they have provided that it covers goods or part whichever you are replacing under warranty, then no reversal is required. Secondly, where there is a case where the distributor based on his stock do the replacement and afterward manufacturer give it to it, under that circumstance also no liability and ITC reversal, because it's like you have used manufacturer goods only, if we see indirectly, because that goods is given by manufacturer and then you are providing. It's just that for time being you have used from your stock. Another thing is about extended warranty. Now for extended warranty, they have clarified in case extended warranty is got from the another supplier. If another person, then the person who has supplied you goods, actually supply you the goods, you have taken extended warranty. First thing that it will be considered as a service. It will not be regarded as good. When it is given as a normal warranty, it became a part and parcel of the composite supply and goods rate is applied. But when the extended warranty is purchased from a person other than the supplier of goods, then it will be considered as a service and it will not be treated as a composite supply. So that's what the clarification that they have brought about the warranty replacement. Then ducts and manholes. This is in relation to telecommunication service, where they have clarified that this qualified as plant and machinery, and therefore ITC will be eligible. Because if you remember 17.5 C and D, works contract service and construction service is specifically blocked. With that, they have given exception only to plant and machinery. And in while defining to plant and machinery also, they have given one exclusion that telecommunication line will not apply. In order to clarify that duct and manholes will not be included in that, it will form part of plant and machinery. Therefore, that restriction which is given in plant and machinery definition will not operate. With this ITC clarification, now we come to the part of related party transaction. Now, in related party transaction, as we are aware that it can, in case of related party or a distinct person means one PAN, multiple GST. And related party is where the partners are same or director are same, or where the company holds another company, shares or manage the control. So where the parties are related or they are distinct person, in those cases, even though where there is no consideration, it is taxable. This is what has been said in section 7(1)(c) and schedule 1. And so now the question which arises and the clarification which they have given is in respect of the 2 points. But before moving on the 2 points, I would like to discuss about the valuation. Recently, they amended the valuation rule 20, which deals with how the related party or distinct person transaction should be valued. Now, normally, as I said, there may not be any consideration, or consideration may not be like section 15, which define transaction value, which says that it should not be between related person. It should be at open market value, at par with the other party when sale or service is provided to the third parties. So over here also, Rule 28 specify either it should be open market value, where market value is not available based on goods or service of kind and quality likes, or if it is not determinable based on Rule 30 or 31, which deals with the cost of goods. But in this Rule 28, there is one more proviso to sub Rule 1, which says that based on ITC eligibility, it says when a recipient is fully eligible for ITC, the value of the invoice declared, the value which is declared in the invoice will be deemed to be the open market value. Now, reason being, as recipient is fully eligible for input tax credit, then obviously there will be no loss to the government. So this proviso provide one exception, thereby where even that sub rule 1 A, B, C has not been followed. Whatever the value has been assumed was considered to be proper and no demand can be made. But to this, they carve out one exception in relation to corporate guarantee by way of sub rule 2. Now, corporate guarantee, even though it is happening between related party or distinct person, they said irrespective of the fact whether recipient eligible for 100% ITC or not, you have to deem 1% of the amount of such corporate guarantee as the actual consideration and you have to pay the tax. Now, with this valuation background, let us move to the clarification issue. Now, our clarification is first limited to sub rule 1. For sub rule 2 corporate guarantee, they have made one recommendation. And by way of recommendation, they have said, like if you will notice, sub rule start with notwithstanding anything contained in sub rule 1. Therefore, in case of corporate guarantee, ITC eligibility will not determine your value. But in recommendation, they have said that even corporate guarantee would also be covered. So maybe they will be bringing about the rule changes. As of now, it's only recommended. For sub rule 1, about the full input tax credit, they have brought in about 2 clarification. Where we have noticed between related person, where there is a loan is given by holding company to subsidiary company or a related party from one partnership firm to another partnership firm. So when they provide loan, now the question which was arising is, will it be regarded as a service? Will it be considered as a supply? Because normally when a bank provide a loan, they charge processing charges. and other types of amount. With that, there is obviously interest on loan. So when banks or other financial institution provide loans and all, the processing charges is considered as a supply. For this also, they said when a loan is provided by one related person to another related person is also a supply. But they are saying over here, when loan is provided, there is no consideration. Means when a one related party provide to another, they are not charging anything in the name of processing charges or other. They are just giving loan. And on that, they are earning interest. Now, interest is specifically exempted, so there will be no tax on it. So as they are not charging anything extra, so they are saying there is no consideration and it will not be considered as supply of service. And the valuation rule which operate in case of related party will not be applicable. Now, again, this circular is going over and above the provision because it is saying where there is no consideration, it means there is no supply. But when we read Schedule 1, it is specifically cover the cases of where there is no consideration, it will still be considered as a supply. Similarly, they have brought out in the case of import of service. So where there is a foreign parent company or maybe a subsidiary company providing any service to the, there is an Indian subsidiary company receiving service from the foreign. So it will qualify as an import. But they have said again, now in this case, as we read about Rule 28, which says if a recipient is eligible for 100% ITC. So if an Indian company is paying a tax in relation to import of service in a related party transaction, over there, they would be eligible for 100%. Sorry, if they are eligible for ITC, it is said, even though no value is charged, I will deem it to be open market value. So this clarification they have provided earlier, they have clarified about the holding and subsidiary company, where they have clarified in similar line of Rule 28 that wherever 100% ITC is eligible, even though no tax has been paid, no transaction, no invoice has been raised, I will consider as a nil. If Circular 199, they have clarified about the distinct person, one branch to another branch. Same line they have also brought in for import of service related party transaction.
Okay, so a couple of points which I want to add here, friends, though I don't want to deal on the loan related transactions, which is not usual in the business, but let's look at the related party transactions where the import of service which has been brought into as a question for discussion. Okay. What is this circular 210 attempting to? First of all, Schedule 1, entry number 4, which clearly says import of service by a person from a related person, okay, or from any of the other establishment outside India in the course of furtherance of business is to be treated as a supply even if made without consideration. So there is no consideration. Even then it should be treated as supply. And the Circular 199 was issued correspondingly where the transactions relating to related parties within India was explained. Circular 199 did not deal with a transaction relating to foreign and Indian entity. So now they have said that it is not just the domestic related party, it would also apply to import of services between related persons. Now, if a foreign affiliate is providing services to a related domestic entity in India, and if the recipient is fully eligible for input tax credit, the value which is declared by the recipient, which is there in the invoice, should be deemed as the open market value. There would be a situation where the invoice is not issued. Now, when the invoice is not issued, why is it not issued? The open market value is treated as nil. Then the clarification considering circular 199, which is now extended to circular 210, will also now say that the open market value for the domestic and the foreign entity would also be nil. If that is nil, the invoice itself is not applicable. Hence, this is okay. Now, why is it important? Because of the RCM entry. The IGST makes it clear that the notification 10 of IGST Act, that the transactions between the parent and the Indian has to be paid under reverse charge by the Indian entity. At what value? Now the value has been taken as nil on the nil, hence the RCM liability will not come. Why is it even more important? Now, look at the case of Northern Operating India service tax matter, where the secondment of the employees were made to service tax. Now the service tax levy is there. Many companies in India haven't taken any position on that. What will happen to them? Today, the department would raise a demand considering the Northern Operating System. So now we have two strong cases. Case number one, I have not raised any invoice, so open market value is nil. The only hitch or the thing that you should consider here is the recipient should be having full eligible input tax credit. Now, what would happen to the fate of the people who do not have? Again, it has to be time tested. Another favorable case here is if at all it has to be paid, I will raise a self-tax invoice today and I will be eligible for taking an input tax credit. So if a value is determinable, let's say, let us look at the secondary adjustment which is done of the transfer pricing. The primary adjustment and the secondary adjustments which are done in the transfer pricing. Now, in all those cases, the Indian entity would be paying under RCM. Now, these adjustments which are done, whether the primary or the secondary, owing to the transfer pricing rules after the 3CEB certificate, even those adjustments would get covered by this, and the recipient can take an input tax credit. Sometimes, why would you do a secondary adjustment? You are willing to forego, saying that I am not going for the purpose of income tax. I will alive and add the interest cost and pay the income tax, but I'm not going to raise any money to invoice to the parent. I'm not going to get the money. Even those cases gets covered now. So every time when a circular is issued, when we are looking at, we should also look at where all the relevant things that would come up. Honestly, most of these cases, most of these circulars has gone beyond the jurisdiction of the law and the act in interpreting it. They're like as Ashika mentioned, they're SSC taxpayers friendly, so no one is going to contest, except one circular which said like the credit note, take a declaration only, then it would be valid. So I think that these are beyond jurisdiction. Still, since it is favorable to me, we will be shutting them out. But you also can see how this analogy can be applied to another provisions. That is more important, right? Yes, Ashika, we can. And friends, now you understand why we are not having a technical session today, because we are only on the circulars. We still haven't touched upon the other aspects. Yeah, so on the special procedure, okay, let me quickly deal with the special procedure provision. Friends, the special procedure is something not applicable to everyone, but this is something where everyone should also know that the department has little moved away from consumption-based tax, destination-based tax to a capacity-based taxation. The department has identified in some category of the goods where the output is not properly being disclosed and paid, taxes are paid. That is what the department has identified. So considering that, they had issued a circular earlier saying that there is a special reporting to be done, special procedure for manufacturer of specified commodities, notification 4/2024, central tax rate at 5 January 2024. They have given a special procedure. Now, though there is not even one, like 0.1% of the population fit into this, but there was a practical difficulty in complying with the reporting of that. What was the practical difficulty? Because department wants to, it is kind of a minimum tax they want to get, and you can offset, like you pay tax basis this and you offset it as and when you are making a sales invoice, so that I can monitor this is your capacity, so much tax you should have paid, you should pay me. And they've asked me in the special reporting mechanism a lot of information about the machinery which I am being put to use. Now, this information is not available in all the cases. Sometimes I use a second-hand machinery. Sometimes I'm importing the machinery made in some country, would be original or the thing. So the details of make, model, machine number. So in the table 6 of SRM1, the special reporting mechanism form 1, the table 6, which had a mandatory field of this, they are now made optional. So this machine number, which is mandatory, if it is not available, you can make from your fixed asset register, whatever is your internal number that you are giving, that can be given. That is one which has been given. Second, they not just the machine capacity, they want to look at what is the electricity consumption rating given. We know these are 5-star, 3-star, 4-star thing. So the production output would change basis that. Now, if the consumption rating is not available, because when second-hand machines or sometimes these are manufactured outside India, which might not be in compliance with putting those rating norms, whatever be the reasons, if those rating norms are not available, you cannot give it. So what the clarification has been given is, the basis the Indian norms, whatever is the rating that is available, get a self-certified rating. When I say self-certified, get a rating done by a chartered engineer. That rating certificate must be uploaded with the form GST SRM1, because that consumption rating is not available. And with regards to the value reporting of non-MRP goods, what is non-MRP goods? You are packing them and sending export goods. So the sale price should be reported in column 8 of the table 9. So various tables, they started giving a clarification. They also said who is a chartered engineer. Chartered engineer means like someone who is having a certificate of practice from whom the Institute of Engineers of India, IEI, that would be treated as chartered engineers. Is this special procedure to be made applicable to people in SEZ? So they have given the relaxation saying that the special procedure is not applicable to the manufacturing units which are there in the SEZ. Now there would be manual packing process that would happen. So in case if there is a manual processing which is happening, so the special procedure is not applicable to the manual packing process. See, they are now looking at only the machine related work, like how in the e-way bill, we say the e-way bill is required when the consignment is traveled using a motorized vehicle. So if someone, a coolie, is carrying items more than 50,000, more than 1 lakh on the head, or a pulling cart, not applicable, right? Likewise, this special reporting cannot be made if some portion of the process is done manually. So if something is done manually, this is not applicable. And if I have multiple machines, let's say machine 1, machine 2, machine 3, like a process 1, process 2, process 3, if there are multiple machines, so they have said that use the details of the machine which is used finally for the packing in the table 6. So they said use that machine which is finally for packing. Then you also need to know that I'm giving some portion to the job work. So I don't have any much details. So what do you do? So they said, if you are giving it for job work, and the job worker is using a manufacturing process in a mechanized way, this special procedure applies to all manufacturing processes, which includes the job work process also. And if the job worker is unregistered, the principal should comply with reporting of this. So this came up for a discussion in 50th council meeting, and in 53rd council meeting, they have brought it in a detailed way. Circular 298 was issued. Basically, the emphasis was more given on the accurate documentation, but they have also given flexibility for the manufacturers who are using the older machines or machines who do not have the information. So it has been now more and more categorically, they said we want this information. We want to relax something, but still we want this information. So these people who are using the notified goods are now subject to give the information. So these are the various clarifications that have been issued out of 53rd council meetings. Our session is not done yet. Yes, Ashika. There are many clarifications which we are waiting.
So now we will come to the part where they have made the recommendation and it's yet to be implemented. So we have divided this into 4 parts. Let us go one by one. First is we have given, it's about the litigation resolution. Now, in this, 4 things are covered, going one by one. First is time limit for availment of ITC. We have already discussed about the time limit for availment of RCM ITC. Now, this relaxation is for all other ITC. Now, you have to remember RCM ITC relaxation is only limited to unregistered person. And this is where the persons are all registered and they have filed, either they have disclosed your details in GSTR1 or not. As we know, there are 2 things. One is belated filing and one is stale invoice. Belated filing, when I say, is where you have filed your GST return by disclosing the fact that how much of ITC in relation to what transaction you have availed, but you have filed after the time limit provided. For example, if we take the financial year 1920, for 1920, last date to avail the ITC was 30th November 2000, sorry, it was September filing date. So 20th October 2020. So September, by way of September 3B of 2020, last was the ITC to be claimed. Now, there may be a situation that any of the return, let's say, for example, March 20 GSTR 3B, you have filed in the month of December 2020. Now, this has been filed after the time limit prescribed. We have got lot of notices and show cause notice where they have proposed to disallow ITC on ground of 16(4). Then comes the concept, this is belated filing. Then the concept of stale invoice, where transaction or ITC relate to invoice of March 20, which actually has been claimed while filing GSTR 3B in December 20. Means invoice relate to March 20, it has been disclosed in December 20 GSTR 3B, and in December 20 it has been claimed. Now 16(4) works for stale invoice, where ITC has been claimed after the due date. Those are time barred. There is a time limit you have to claim. It doesn't operate for a belated return. But number of notices and litigation is going on, how the same should be. Further, as sir already discussed, there was initially when they came up with GST, there were matching concept. There were different forms they prescribed. In the form, they also prescribed how a supply, even the data which is furnished by supplier, recipient has option to modify it, accept it, or reject it. But as those were not implemented, people were not fully aware. Some transaction may be missed out. There are cases where belated filing has happened due to some reason or the other. Now, to put an end to it, recommendation has been made that for the financial year 17-18 to 2021, it is only operational for 4 years. Relaxation has been given only for 4 years. 1718 to 2021. Plus, relaxation has been given only when ITC has been claimed through 3B. Relaxation is only when ITC is claimed through 3B and which has been filed before 30th November 2021. So all the belated filing of GSTR 3B and stale invoice will get covered. And even though it is time barred, stale invoice, you are eligible to claim the ITC and based on time barred. This ITC will not be disallowed. But over here, what they have said that it will open only when the same has been reported in 3B. Now, there are instances where the cases have been filed before the High Court, where the people have missed to claim in 3B, but have claimed in GSTR 9, or have in books, but missed out in 3B. And the way, the manner they have made the tax payment based on books, that has not been addressed, but this is a welcome recommendation because it will put an end to number of litigation which is going on 16.4. Another relaxation which they have recommended is about revocation. Multiple of GST registration has got cancelled due to non-filing. Some they have even cancelled from retrospective even where the returns have been filed. Now, as registration when get cancelled, business doesn't get stopped. There will be still going purchase and sales. Simultaneously, a business person will also try to get it registration restored. So what would about the fact which is in between the period, the date from which your registration got cancelled and the date when this registration got restored? What about those purchases and sale? Now in this, they have said that they are going to make the changes in the provision whereby they will allow the ITC availment and time limit which is given in 16.4 will not be operational, but subject to the condition that after revocation of order, you should file within 30 days. So within 30 days of revocation of order, you have to file all your returns and you have to disclose your purchase and sale. If you do that, ITC will be eligible. But when I see the revocation part, they have only cover from the point of view of the supplier. What about recipient? If in case for recipient, it is getting time barred under 16.4. As of now, nothing has been discussed on recommendation. Let's see for that.
Yeah,
This
so only one point which I would like to add is why there is no clarification or circular in it, because though the circular went beyond jurisdiction in some cases, this is something which needs to be amendment in the act. So there might be a proviso that can come under 16 subsection 4 in the budget. That's what I am hoping, which will say for the financial year up to so and so, 17-18 to 2021, we are giving this relaxation. And they might also come up with a condition. So just because you have availed credit, that doesn't mean that the credit would be unanimously available. So it might be visible in 2A. There could be a situation that the credit availed has been challenged, not under the ground of 16.4, but under 17.5. So those we have to see. There are other nitty-gritties that will come up. How the procedure would be laid down in making this effective. One point you need to know that if the procedure is set, two types of SSS who said, okay, I don't want to get into issue. They have paid the taxes through DRC 03 and went silo. The other set of SSS who are fighting, to whom this relaxation is available. Those who went for an appeal, for them this would be allowed and eligible, or for those who have, it would also include for those who have genuinely fit under this provision for and paid the taxes. Again, I believe that taxes once paid, refund cannot be claimed. So it's only for those. So that is where whenever you have an iota of doubt, when there is a conflicting thing, please pay the tax, but keep your right. So keep these taxes will become like under protest if you file an appeal. Yes, Ashika, please proceed.
Another important recommendation, which is waiver of interest and penalty. Now, this has been made for the period 1718 to 1920. So this is for 3 years. So if you will notice, there are different period they have covered, tax period, and accordingly they have given certain relaxation, but it need to be checked on case to case basis whether you are applicable or not. So over here, they have given waiver of interest and penalty, but that is only applicable to the case of section 73. Now 73 relates to demand and recovery of notice where there is no fraud, suppression of fact, or willful misstatement. 74 is a case which is related to fraud, willful misstatement, or suppression of fact. So in case your notice is covered under 74, you won't be eligible for it. It is only for 73 cases where this waiver of interest and penalty will come. Further, if you will notice that they in the recommendation, they have said tax is to be paid full by 31st March 2025. So they are giving us the time to decide the case, and accordingly, based on which management can decide whether to go ahead or not or pay the tax. So it's like an amnesty scheme they have given, where because 1718 to 1920, all the due date to issue the notice under 73 is already over. 31st May was the last day to issue the show cause notice of 1920. 1718 and 1819 is already over. Only the cases to file to issue the order for the year of 1920 is as of now pending. Adjudication of 1920 is only pending. Apart from that, 1718 and 1819 already order has been passed. Maybe the people may have got for appeal, or it may be a case they might have paid tax, interest, and penalty and closed the case. But as of now, this option has been given where the person can decide whether they have to go ahead or not. Plus, this is not applicable where in the case of refunds. If there is a case of annual refund, it will not apply because it's only for the demand. Second, like Sir said also, that no clarification has been given or nothing has been mentioned about the situation where what would happen where the SSC, instead of going on litigation, has choose the option to pay it and close it. Whether refund will be eligible or not, it's a point of debate. But till the time it comes actually in the section, because this is going to come through act, then only it will be decided what would happen. Another welcome change which they are going to do in the rule is interest on electronic cash ledger. Now, as we know, now when we are calculating our liability, first thing, gross versus net, which was a huge issue when the GST was introduced in first 2-3 years. After that, they clarified that you are liable to pay on a net tax liability, which they said that is cash. Now, there are situations where the people make the deposit in electronic cash ledger, but may not adjust it by 28th. It can be a case that returns may not be filed within due date due to some or the other reason, maybe technical issue or some other manner that they were not certain and delay happened. They were not having full fund which is required to pay the tax. They are having part of it. Any of the circumstances. So now, even now also, we are paying our interest on net tax liability, that is on full cash amount which we are discharging in our 3B, we are paying interest on it. Now they have said that it will not be calculated based on how much tax you have discharged in cash. It will be based on after reducing the balance available in electronic cash ledger. So if you have made a deposit in electronic cash ledger, even though you have not adjusted or you have not filed 3B by adjusting it, on that amount which is lying in electronic cash ledger will not be applicable for interest. So the amount which you have paid in excess of your electronic cash ledger, means after the GST 3B due date, on that you will be liable to pay the interest. This is also a welcome provision which they are going to insert through another section 11A. 11 is power to give exemption, and 11A they are giving power for non-recovery. Now it has been noticed in various trade practice, they assume that on this we will not pay the tax. Like Example is club and association, where they brought about retrospective exemption, retrospective taxability, and they introduced under Section 7 saying that principle of mutuality will not apply. Transaction between members and association will be taxable. Now, over there they have made taxable, but over here they are introducing this in order to provide power to the government that they can say where their practice has been followed, they can regularize. So there would be no levy or short levy of GST. So wherever a person is having any confusion or any classification issue that it should be 5 or 12. So based on the trade practice, under this, they will issue the notice, which will also ensure reduction in litigation. Now, appeal related changes. The first thing which they have brought about in pre-deposit limit, they have reduced. Now we filed 2 appeal stage under GST. One is appellate authority, that is before Joint Commissioner appeal, and one is appellate tribunal, which is going to be set up. As of now, only president has been elected. So in case of appellate authority, we are liable to pay first appeal, which we say we are liable to made a pre-deposit of 10% of disputed amount. If you will notice, I am writing about disputed amount. I am not talking about admitted amount. Means if you are having a demand of 5 lakh, out of which 2 lakhs you have accepted and paid, that's okay. 3 lakh you are disputing. Of that 3 lakh, 10% need to be paid. So over here, they have said 10% of the pre-deposit I was required to pay earlier, but there was a maximum limit that pre-deposit cannot exceed 50 crore. Now they have made that maximum limit of 50 crore to 40 crore in case of first appeal. Percentage of pre-deposit in first appeal is same, 10%. But when it comes to appellate tribunal, there was a additional 20% I was required to made of disputed amount. Now it has become 10%. So over here, they have made reduction in percentage of pre-deposit limit. Secondly, like subject was maximum was 50 crore, they have brought down it to 40 crore. This is one. Second part, as when they were issuing order, some of the order were not getting uploaded on the portal because we use our GST APL 01, and while filing GST APL 1, we are required to make the pre-deposit through APL 1. But as online model was not operational or even operational due to some technical issue, people could not file, and they have made the payment through DRC 03 for pre-deposit. So this is also welcome that they are going to prescribe a mechanism where the person who has made pre-deposit through DRC 03, maybe due to manual submission or technical issue, they will come up with this adjustment, therefore ending the confusion which people were having, what would happen who have made the payment through DRC 03. So they are going to come with that mechanism, align the adjustment, and therefore, obviously, when the appeal person will win, so there will be a proper mechanism to get the refund even of the pre-deposit made through DRC 03. Then another confusion which we are going was what should be the time limit to file appeal. Under the Act, as this time limit for appeal is for appellate tribunal, because joint first appeal is operational and people were able to file within the time limits. Even they came up with the scheme also where they provided even the people who haven't filed, they can file it. Those all are over. Now the issue which has been addressed over here in the recommendation is about appeal to be filed before appellate tribunal. So 3 months has been prescribed under the law. 3 plus 3 months with in the limit and 3 months with condonation of delay. So over here, they have provided that appellate tribunal, when the appeal to be filed, they will give the date, notify the date, and based on that, 3 months to be calculated. Now coming to the demand. When we talk about demand, it is relating to section 73 or 74. We talk about waiver of interest and penalty, which is in relation to section 73. Now, in this, which is we are talking about 73 is 74, that if in this they are going to come up with a common time limit for issuance of notice. So as I discussed, that 73 deals with the case where there is non-fraud cases and 74 relates to fraud case. presently under law, they have provided different time limit. For issuance of order for 73, it is a 3-year from the due date of annual return. And for 74, there is 5-year time limit. And based on the order, they have provided that notice required to be issued 3 months prior to issuance of order under 73. And for 74 cases, it should be 6 months. So as you can notice, presently there are different timelines for issuance of notice and order under 73 and 74. They are going to come up with the new section and going to give a common time limit. And that will also be based on demand of notice. So order concept is going to be over. So time limit will be prescribed for issuance of notice, and there will be common time limit, whether it's a fraud case or non-fraud cases. Thereby, it will provide more time to the officer to properly investigate their case, and even it may prove beneficial to the taxpayer also, because they will also get a time to explain and defend their cases. And this common time limit, it will not be applicable for previous year. They are going to introduce from 2024 and 25. So it will be applicable from the current financial year. Another thing, earlier they have given a 30-day time limit to decide whether you want to pay or not with reduced penalty. That 73 provides that there will be no penalty if you pay the tax and interest within 30 days. And 74 provides for 10% penalty. Now that they have extended it to 60 days. Now 2 months time period will be there for SSC to decide whether to pay the tax with interest or not.
Yeah. Ashika, with regards to the changes in the rates, we can actually skip because we will have to await for the actual notification, and we will move to the other point, which is GST or 1 year related. So
Service part, sir, I just want to cover two things.
No
One
problem.
is accommodation service. Like question was going about that, what about the hostels, PG, which are actually commercial establishment? Because if we see hotels and all provide on a day basis, but when we see to hostel PG, they provide on a monthly basis. So there was a dispute that 1,000 limit, which was applicable to that, will apply to this or not, though there were various AR and decision has been given. But in that context, it's just that they have come up with an exemption where they have provided 20,000 per month for accommodation service. We have to see, obviously, like sir said, how the notification they will bring and how it will be applicable. That will be checked. Second part is about the real estate industry. So RERA related statutory collection, which has been made, on that no tax is applicable under RCM, because there was a doubt whether it will be considered as a service provided by government or not, because if it is a government service, then RCM applicable. So over there, they have given an exemption under entry 4. This too only I want to cover.
Giving the exemption was also very important. If it was treated as not in RCM, then these RERA authorities were supposed to make this payment, because they are collecting a percentage of the project as the penalty, fees and other things. So they gave an exemption, but even here, we still have to wait for the detailed thing. Let's look at the one other important aspect which you should be aware. Of course, we will be getting the detailed thing soon, is GSTR 1A. The next slide, Ashika. Yeah, so there is an introduction to form GSTR 1A, which is proposed to facilitate the amendment of details of form GSTR 1. What is the introduction and why? Firstly, from the long time, the government has been contemplating to lock 3B. That means the output will be coming from GSTR 1, input will be coming from 2B. I don't need to change neither the output nor the input, just that I can reduce the input by way of reporting in 4B1 or 4B2, or avail the carry forward credit from reporting by 4D1, something like that. They want to simplify and move on. Now, there has been a lot of people saying that, okay, I have to amend because I have reported wrongly in R1. So then now brought in the concept of a form 1A, which was there earlier. But earlier when the form 1A was there, the concept of R1A earlier was only dealing with the changes that someone were making amendments to that was coming in 1A. So the feature was only accept reject. So that concept is gone, done, dusted. It's a new 1A concept wherein I can pick any record. I can pick any record, any table of GSTR1 from right now. When they are launching, they'll be launching up to table 13. 14, 15 will be coming soon. So between table 1 to table 13, that means including non-tax liability tables, that is on table 13 document related, table 12 HSN related, or table 8 the exam nil related, all those things can be amended. Now what is the advantage of it? So once this amended, the revised values will be going to GSTR 3B. The amended liability will be auto populated. The existing tables of R1 will be considered for R1A. So the new values will be coming. So that means in R1A, you will be entering the new values. Please note, you are not going to enter the delta. I am sure most of the people will make a mistake of the data which is coming in 1A, they will delete everything. I forgot to add a record, I will add a record. I only want to correct a record, I will only correct a record. No, it's not a delta, it is a re-reporting of 1A. This is something very critical. And how long I can do 1A? Till the time of I'm filing 3B. If I'm filing 3B on 20th, till 19th, I can do 1A. I'm filing my 3B on 26th, till 25th, I can do 1A. After I file 3B, 1A gone. We had this concept of mandatory filing of 1. Even if you do not have turnover, you have to file 1 mandatory. That doesn't apply to 1A. So if you have nothing, you don't need to file anything. It also facilitates you to change the nature. Like your invoice was same, it was reported as export with pay, now you want to change without pay, or it was outward RCM was ticked, you don't want to untick. All those things can also be changed. Even that change is also permitted. The moment you make this change, the corresponding R1A changes will be visible in your 2A, 4A and 6A. The moment you enter that, it would be available there. File saved or record. The moment you submit, it will say submitted, all that information. If you make change entry in 1A and delete it, it will get deleted in 2A before you submit. All those, the mirror replica of 1 to 2A and 1A to 2A is going to happen. But where will it come in 2B? Since your 1A is amended after the 11th, it will be visible in the 2B of the subsequent period. Now, should I wait for till 11th for 1A? Answer is no. Let's say you did your 1 on 5th of the month. On 6th, you can do 1A. On 6th, you can do 1A. Since your 1A is before 11th, these values will get auto-populated to your 2B of the same month. What goes to GSTR 9, the table 4, is the updated auto-populated value of 1A. One important point is once you filed 1A, you cannot amend. If you change the record in 1A, you cannot further change into the next return. So that is also very important. You cannot change that once it has been filed. So these have come. So very important that this is going to come. You should be very mindful of. They have also made some other changes, which is the threshold report for reporting of B2C large transaction in table 5, which was there 2.5 lakh. Now they are reducing to 1 lakh. Again, the notification is awaited for that. GSTR 4 for the financial year 24-25 will be made up until 30th June. 9 and 9A exemption for the current year up to 2 crores because that have to be given. So that also they will be giving. And GSTR 7, so there is a provision for waiver of late fees and nil returns is being considered. Yes, sir. The another procedural things with regards to the refund on account of upward revision, they will be prescribing a mechanism to claim a refund on the additional IGST paid, which has been where the goods have sent, I raised a debit note to claim, because I don't have a shipping bill number to auto claim the refund. So they will be giving a provision to it. And in terms of the refund, which is something which is subject to export duty, that would also be given, and refund restriction will be brought in. Corporate guarantee between the related person, we have seen ISD, there looks like they'll be making it more mandatory. And they brought a sunset clause for the transitional credits in ISD, and also sunset clause for the anti-profiteering. They said these matters appeal can also be had, and there is a new application regarding the anti-profiteering, the compensation, not the competition act that have come and that have taken over. They have also proposed to reduce the TCS rate from current 1% to 0.5%. And they're now putting penalty under the e-commerce operator who are supposed to do TCS and they're not doing TCS, the penalty will be on the e-commerce operator. Yeah. These are the various clarifications that have been brought in. And if you have any questions, feel free to ask your questions. We are here for some more time. Of course, some of them you have asked for the presentation. Copy of the presentation would be reached to your registered email ID. Any questions to anyone? You can unmute yourself and ask, or you can put your question in the chat. I know the theory session so long, it's a little boring, but yeah. So that is why we skipped the technical part of it. You might understand that how lengthy the discussion is.
So there are a few questions in chats. One is monetary limit on the basis of turnover or tax.
I guess this is for the appeal to tribunal. Yeah, this is on the tax, that the demand which is proposed. So for all, though the power they have to go for cross appeal, they don't want to go to cross appeal. It's purely based on the demand that is being created. And by the way, those wanting the presentation, you'll be getting a feedback form. Once you fill the feedback, you will also get a link there. You can just download the presentation from there itself.
So one person is asking whether I can claim refund if I have paid tax, interest and penalty based on waiver.
The right answer is I don't know, but I would say that you should make an attempt.
So that's all.
Okay, friends, thank you for joining and staying with us so long, and special thanks to Ashika for compiling the whole of the presentation and walking us through the complicated 16 lengthy circulars into a simple, lucid way for us to understand. Thank you, everyone. Thank you, Stephen, for managing whole of the show. Thank you, everybody. Good day.